get this started, keep us on time. Welcome back to day 2, One-to-One Mining Investment London. I'd like to introduce our panel. We've got a selection of investors and analysts here going to be talking about strategies to capitalise on this next phase of the mining boom. And Jamie Strauss is going to be anchoring this one. Jamie's our sponsor, Digbee. And Jamie, I'll hand it over to you to take us through. Thank you.
Morning, everybody. So I'm Jamie Strauss, and founder and CEO of Digbee. And I have an esteemed panel with me today. And the title of this panel is Capitalising on the Next Phase of Growth in the Metals Mining Industry. And maybe to set the scene, before I ask the panel to introduce themselves, is if you go onto BHP's website, you'll see that under their 1.5 degree scenario, that over the next 30 years, copper production will need to increase 2 times, nickel 4 times, steel will be 2 times the amount of use or produced than over the last 30 years. And I think separately, lithium is going to go up 10 times. They also talk about recycling, which I think will become increasingly important as part of any of these conversations and conferences that we have over the course of the next 10 or 15 years, an important part of the transition. So with that, I think what I will do in terms of valuations and the next part of the growth, let's ask, maybe starting from the left, if I could ask the panelists to introduce themselves.
Sure. Morning, Ben Davis from Liberum. I lead up the equity research mining team over there, have been there for about past 9-10 years, another 4 years before that at UBS. Certainly very interested in the CapEx sort of outlook, and we've just done a significant amount of work, and yeah, we're at an inflection, but it's not quite showing up yet, so it'll be interesting to see what the panelists think it's going to go to.
Good morning. My name is Graham Dallas. I'm with the TMX Group. I represent the Toronto Stock Exchange and the TSX Venture Exchange in Europe, based in London. I am, unlike most of the people at the conference, not a mining specialist, but given that about half the market cap of the Venture Exchange is mining companies, an awful lot of what I do is involved with mining companies, and it's probably the single biggest and most important sector to the exchanges I represent. So I am, although not fully specialised, closely involved with the mining companies.
Good morning. My name is Ian Williams. I run the Charteris Gold and Precious Metals Fund, which invests in gold and silver mining equities.
And I'm Rob Crayfourd. I work at CQS, which owns New City Investment Managers, and I co-manage on 3 resource-focused investment trusts. So we've got the CQS Natural Resources Fund, Golden Prospect, and Geiger Counter, which is Golden Prospect, obviously precious metals. Geiger Counter is a uranium-focused fund.
Excellent. Thank you, Rob. We must come back to focus on uranium. It's kind of the talk of the town at the moment. So, so let's start, first of all, with the first question, which the conference organisers put together, which is capital markets are open again, and after many bearish years, are mining company valuations where they should be? Well, having been in the industry or into the financial markets for years, the markets are always right. So whether or not they should be today where they are where they are. So maybe let's just change this a little bit and initially start from the research side of things with Ben, perhaps your view on where they're going. And where you also think we might be within the cycle, which is now fully obviously underway in the space.
Yeah, absolutely. It's certainly always tough to get in terms of the time frame to how these valuations are going to move. I mean, to really get people excited and actually see a re-rating, I think the market would have to assume that these are growth stocks once again. It's not just a pure China story. There's other obviously huge thematics out there that are going to drive demand. But till we get to that stage where the China question is less of a a sort of a doomsday sort of scenario versus what we can see in terms of very other interesting aspects, it's going to be hard. So I think re-rating will come. But it's probably more a 12 to 24 month view on our part rather than a re-rating in the short term.
So just before I go on to another panelist, I noticed in a recent chart that I think the EV/EBITDA is now at the lowest level since the early 1990s. So is that quite often when we're at extremes? it's usually a kind of precursor for something about to happen. What do you think that next? What do you think that maybe that trigger point might be?
Yeah, I mean, it's certainly the implications are that we're at the peak of cash flows, certainly for the majors, and we're where commodities price are. We are significantly above the cost, above the marginal cost, so they should be trading cheaply, as it were, on the assumption that they're going to go back to that marginal cost. However, that's might not necessarily be the case, and it's just the market confidence in that's going to continue at these rates. So, yeah, it's tricky. Again, they should be cheap because of what we've known in the past and how commodity markets react because of the lack of supply discipline. But if that supply discipline holds, then those prices are starting to start looking a lot more reasonable.
Thanks, Ben. And Ian, I guess where Ben's really talking here is the risk of inflation on the cost side of it. So do you feel as though inflation is fully bedded into these valuations? And or how do you see that effectively going forward in the course of the next 2-3 years on the valuation side of things?
Okay, well, we do our own in-house cycle analysis, and this is market cycles, particularly commodity cycles, and that puts us very firmly in the same camp as Jeffrey Curry at Goldman Sachs. This is the first leg of a commodity super cycle that's going to peak around 2026, 2027. So from where we're coming from, you ain't seen nothing yet.
That's very clear. Rob?
Yes, I mean, so there's two sides to inflation. So yeah, there's clearly going to be some cost creep for the producers. So we're typically putting in 5%-ish type numbers into cost creep. But I think it's more important actually on the revenue side. So if you look to which assets perform well in an inflationary environment, commodities do in general. If you get a stagflationary environment, then gold especially does, and precious metals. So actually, I think that side of it is actually far more important and far more volatile than the underlying cost input basis. Clearly we have seen energy costs creeping up, but much of that has kind of happened. Can oil go from 80 to 100? Probably actually, if you look at supply demand aspects. But overall on the cost aspect, yes, deals are feeding through, etc. But that just has more of a knock on to people not actually wanting to build new projects, and actually probably puts more value on existing ones.
Okay, interesting. Graham, in a slight different take on the question, you've probably got your finger on the pulse of the number of companies that are moving from being a tech company to a mining company. So the growth and to some extent, by all means, add into the conversation on valuation. But how do you see these trends with regards to the companies moving onto the exchanges taking place? Is that still as fast as it was, say, in the last 12 months?
It's picked up, if anything, over the past 12 months. I think we've had about 60 mining companies, new listings so far this year, and about $8 billion raised so far this year, which is more than was raised in the whole of 2020. So the pace is solid and strong. It's always very hard for a stock exchange to speak about valuations. The valuation is, as Jamie said at the beginning, always correct at any given moment. I think one thing that really strikes me as maybe as a non-specialist in the sector is, we've got about almost 1,200 listed mining companies, and the aggregate market cap is $500 billion. It sounds great, doesn't it? But what's the market cap of Apple? So this is still a very, very fragmented, almost an atomized industry. And I think one of the things that's going to drive valuations is actually M&A, as mining companies, producers particularly, well, really producers, start to join together to achieve scale where they can sort of join in the fun of the passive investor universe, which they've, to a large extent, are excluded from up until now. And I think we're starting to see that. There's been a few transactions this year, and I think BMO put out a report a month or so ago saying that they were looking for this sort of thing as well. So I think one of the things that may actually drive valuations, really specifically at the sort of larger cap end of the mining market, will be M&A. I can think of other reasons why M&A is going to be an important driver. We'll perhaps come on to that a little bit later in this panel. But right now, I think companies are looking for ways to get themselves in front of a bigger, wider, different investor universe of generalist and passive investment fund managers.
Well, let's take your lead on M&A then. Let's go straight into that, because I think we all know a lot of people wanting to get involved in this industry are driven by the M&A world. There's been a lot of capital discipline over the course of the last 10 years in almost put in place by the investors from the last cycle. I think capex to date at the moment is around about $40 to $50 billion a year at the moment, gross capex. And I think that peaked back in 2010-11 around about the 80 billion dollars, or 65, 75 sort of level. So do you feel as though this capital discipline is going to continue? And how I'm going to bring that into the M&A side is that if that capital discipline is going to continue, then is there a risk that the OEMs and others more in the base metal side as opposed to the gold side, we hark back to the days of the 1970s, 1980s, when BP and other non-mining companies, shall we say, got into the sector and buy out the prize assets within the thing. Ian, I respect this is not specifically your area; it's more base metals and everything. But do you feel as though the capital discipline is going to continue, and do you think whether or not this is going to constrain potential M&A or perhaps leave some of the miners wishing this capital discipline imposed on them is not quite as strong? Who wants to go first? Okay.
Well, I also run an equity fund as well, which is full of base metal miners. Okay. So it does actually cover what we do. The way we see it, if our underlying view is correct, that we've got a big 5-year bull market in all commodities in front of us, partly driven by Federal Reserve monetary policy, but also decarbonisation. I mean, you can't have decarbonisation without metals. So if the world's going to move to electric cars and wind farms, it requires a gargantuan demand for things like copper and nickel. And we foresee that M&A is a function of a bull market. The higher the prices go, the more people want to driven fear and greed, but not fear of losing money, fear of missing out. And copper in particular is going to be a prize asset. I mean, companies like Rio Tinto are too heavily, their portfolio of assets is too heavily concentrated in iron ore, and they need to start getting into sort of copper and expanding as a proportion of their portfolio. So if what you say turns out to be true, that the non-base metal mining companies start to see some of these prize assets taken by others, particularly Chinese state-owned mining companies who have their eye on dominating the electric car market in 10 years' time, fear of missing out will change the mindset quite quickly. And in a rising environment, of course, they then have the rising cash flows and increased confidence, and that the banks will then finance projects and shareholders will finance projects. So I think it will be driven in a bull market environment. Fear of missing out will be the big driver.
Yeah, I mean, I definitely echo some of those thoughts, and I think the Chinese M&A interest could be the thing that really triggers that. But I think there's two sides to it. So firstly, there is capital discipline. Shareholders are demanding dividends, debt pay down, and this is against strong cash flows. But this has really taken a shift in the last 12 months towards that kind of green focus. So what we're seeing now is, even though capex numbers kind of remain flat year on year, an increasingly large amount of that's being diverted towards improving emissions or general sort of cleaning up of their existing operations, which otherwise would have gone towards new supply. So all in, this is a very bullish backdrop where shareholders are demanding it, and then money's being diverted elsewhere, which isn't going to new production, and then the countries in which many of these companies produce, particularly if we look to sort of Chile, Peru, are becoming increasingly difficult to build and add new supply in. So this points to an environment that we have no real new supply coming through, and we know the long lead times even at that point that you do reach FID anyway. And at the same time, we've got a clear increase in demand in particularly certain commodities. So there's some super cycle sort of comments thrown, but I think that is relevant to certain commodities for sure. Particularly copper would be one that isn't replaceable.
Okay, Ben. Oh, sorry, Graham.
I was just going to build on what Ian was saying. I mean, about the Chinese companies. Is it Ganfeng? Ganfeng have already bought Bacanora, and they're trying to buy another lithium company.
They haven't bought it yet. I'm on the board.
That's
so,
right, okay. So, I mean, that's here. That's happening.
Yeah.
Yeah. No, for me, I don't think it's necessarily about capital discipline, particularly balance sheets are the most unlevered they've been since basically 2003. But it's more about supply discipline. And the best way to maintain supply discipline is to buy it, not build it. So I think particularly, as you say, for companies like Rio Tinto, where they've underinvested in the optionality of project growth through lack of exploration spend, or, just in terms of the options they have got, they're no good. It's got to come to, if you want a quicker fixed solution to their lack of diversification, it's got to be buying a producing asset. So yeah, I think M&A is definitely on the cards for all of them.
Okay, and I just want to come back to the gold space. So I was on a panel earlier this year where we put in quite a lot of work to understand the flows of money going into the different forms of exploration. And what was clear to us then was that the historical amount of money going into the gold exploration space, which I think has historically been over 50% of the entire market, was beginning to potentially shift towards the coppers, the other base metals, and obviously battery metal complex. Do you see that as a continuing trend, or do you feel as that's a kind of shorter term trend over the course of the last 12 or 18 months? Who wants to go there? Graham, are you seeing that with your, in terms of the split between base metal gold companies coming onto the TSX?
At the very junior level, no. But as you step up a level from the very early exploration companies, yes. I wish I had the numbers to support it. If anyone's really interested, I can dig them out. But yeah, I mean, that certainly seems to be the case from the sort of level of inquiry and the level of activity as I perceive it, that, the battery complex, nickel, lithium are areas where there's a particular amount of interest. But, Toronto is kind of a gold market, and I think probably will be as long as there is a market in gold. So that certainly hasn't gone away. And the M&A activity that I was talking about earlier, that's been much more focused in the gold producers up until now. So I wouldn't want to overemphasize it, but I think yes, I think it is a trend. And, presumably from what's happening in the world, it's a trend that's only going to strengthen, continue and increase.
Yeah, the other metal that's going to benefit from electric cars and all the sort of Wi-Fi and everything that's going to go into new cars is silver. So silver is potentially a lot more interesting than gold, because it's difficult to see too much of a role for gold in electric cars. But there is a role for silver and copper, so the nickel. And so if you're looking at which metals are going to be the biggest beneficiary to this move to not just cars, but charging stations, wind farms, all the whole thing, it requires a gargantuan amount of copper. I just watched a research program on this about a month ago, and they said that the demand for copper over the next decade will be 1 billion tons, which is more copper that's been mined in the last 2,000 years. Now, where it's all going to come from, nobody knows. So, and potentially silver's gone peak production in about 2015. Has been declining, and people tend to forget about silver when they talk about electric cars. But the new cars of the future are going to be a lot more digital gadgets in them. So there's going to be big demand for silver as well. So for us, the two potentially big winners are silver and copper.
Anybody else want to comment on that before I move on to another important subject?
Well, I think there's a function of the projects themselves. So, copper projects generally are much larger capex bills and longer lead times towards production. So, that adds an element of uncertainty. I think geopolitically, I think the countries in which many of those exist have been kind of a little bit less certain. And obviously gold had a bit of a rally, a couple of years ago before we kind of had this move more recently in copper. So, I think that's why it's led on that side. I think what we see in copper is a bit more strategic. So you kind of see some Japanese trading houses coming in, or, I think the Chinese will certainly be central to that. But, it's a real requirement for need of offtake and security of supply. We've got a scenario now where we're having, what is arguably very bearish headlines coming out around Chinese property, Evergrande, Contagion through, Fantasia, etc., all of these Chinese property developers. Yet we've got, copper barely reacting. Okay, we're down in the last couple of days, but this is because we have really low inventories and there's no easy source of new supply. So people are looking through what is arguably quite negative near-term news and looking forward to that kind of mid-term demand cycle and build out and Chinese grid expansion, general electrification, etc.
Okay. So we've largely talked about the corporates and the commodities now, and I think the important side of it is, I guess one could put it, is mining becoming uninvestable, and therefore looking at the investor side of things. So what is going to bring new money to this industry? I think there's an argument to say, and certainly I'm seeing it from my own business, that doors are closing, particularly in Europe, on a daily basis with regards to lack of disclosure of ESG-type related disclosure. But is there an opportunity to turn that around? What is going to effectively encourage new investment into this industry to drive effectively the growth which we're talking about over those next 20 or 30 years? Or is the cost of capital just going to go sky high as the industry becomes more and more difficult to deploy capital into for some of these constraints that are on it? Who'd like to go first? I think everybody's putting their microphones up. So we'll go from the left and then go left to right.
So firstly, I think this whole capital restriction thing or this whole ESG concern is actually incredibly bullish for our space. Anything that constrains supply. I mean, basically what we're seeing now, it's completely broken that capitalist response you normally see to higher prices, where you would expect to see a surge in new supply, and then you run through these cycles. At the moment, we're seeing stronger pricing and no real supply response. So firstly, it's not negative, but then what changes that? Well, firstly, I think resources in general have been a relatively small part of our overall benchmark. So, circa 3% of MSCI World. So it's been very easy for a generalist investor to ignore, even if it kind of, does 50% in a year, it doesn't overly impact their overall. And clearly they've generally been better just holding some of Amazon and Facebook over an extended period. I think what we're seeing now, so they are seeing ESG pressures, and we're seeing funds sort of banding themselves either Article 8 or Article 9. So they can still hold resources, but I think where you really see that disparity is on the sort of dirtiest of the commodities, which is why you see coal trading at such a huge discount and high free cash flows relative to others. And that's kind of feeding through. I don't think that transition's ended, but I think it's definitely slowing. I think so many funds have now badged as that Article 8 that I think that flow that way is slowing. And actually, I think the shift now is transitioning more towards funds that are looking to try and create positive change. So, you look to the sort of Anglo-Thungela scenario, that's clearly not a success for the Greens who are campaigning and pushing that way, because you've now lost control of an asset that you could have potentially managed down.
Okay. Ian?
Yeah, I mean, the environmentalists are pushing the ESG point of view have to wrestle with the fact that unless you mine ever-increasing quantities of metal out the ground, you can't move the transition from oil to electrification. Without metals, there's no decarbonisation, there's no electrification, it can't take place. So the trouble with box ticking, say, mining companies as non-ESG friendly is the very thing they want to achieve, which is electrification and doing away with oil, is impossible without mining these metals out the ground. And one man's ESG investment is another man's non-ESG investment. It's all very subjective. And so, and you've only got to see, take Rob's point, you've only got to look at the oil market to see what happens to the price when the environmentalists start clamping down on supply. The price goes through the roof, and that hasn't even started yet either. I mean, apparently the ECB is going to bring in some rule that prevents any European bank from financing any oil industry. Well, all that's going to happen is that non-OPEC supply, if you don't invest in these oil fields to maintain them, the flow rates start to dry up. So non-OPEC supply potentially is going to fall off a cliff over the next few years. OPEC isn't going to be able to make up the balance. The transition to oil isn't going to take place for another 10, 15 years, if it takes place at all, because Asia and China and India are going to be very reluctant to come off. They won't even come off coal. Well, there's no way they're going to come off oil and natural gas. So the price of the energy costs potentially go through the roof. So it's all law of unintended consequences and these politicians getting involved. But, oil could go much, much higher than this over the next 4 or 5 years, because non-OPEC supply is 65% of the market. It's bigger than OPEC. And OPEC hasn't got the spare capacity to make this up.
Just before Graham comes on, just do think of any questions. We're going to try and leave 5 minutes at the end. So if anybody's got any questions, do be prepared. Graham, do you want to follow on?
Yeah, I think on the ESG matter, I think the market isn't just the public markets, and I think there's a danger and an opportunity. The danger is that if conventional fund managers and sources of investment disappear from the mining sector isn't going to disappear, but it will be funded in other ways from other places and perhaps managed in different ways, less transparently and with less sort of response to ESG concerns in society at large. So that's the danger. The opportunity is that mining covers an enormous range of different activities. Some of it is as it covers an enormous range of different activities, different materials, different processes, different levels of impact on the environment. And if we had some ways of actually measuring that and disclosing that, then we might be able to persuade our current investment community that mining is, in fact, in some ways, highly investable for all the good reasons, because if we're going to make this transition to new technologies and a new way of powering the economy, we're going to need a lot of the raw materials that come out of the ground more and more and more. It has to be funded somehow. Let's do it in a transparent way, ideally on public markets. And I'm not just saying that because I work for one.
Ben.
Yeah, I think it's a funny situation, because there's a mismatch between the ESG discipline with the supply, which is largely dominated by international capital markets and providers, versus the demand section, which is Chinese and other emerging markets. So when you do, like you say, with oil or any of these other places, the supply discipline came a lot quicker than the demand discipline. So you're going to see runaway prices in a lot of commodities. And even if they do eventually settle down as demand comes down, the supply is never going to be there to fill in the gap. So it's always going to be an upside risk. So ESG, it definitely is going to have some winners and losers. But for the most part, because supply is acting quicker, it's to the upside, not to the downside at this point.
Okay, and so taking that one step further, do you feel as though the sector and in its different constituents, call it exploration, development, production, whatever, do you think the industry is addressing this issue quick enough in order to keep up with investors, institutional investors particularly, and society as a whole, demands for greater transparency and disclosure? Ben?
Yeah, I mean, it's difficult for a company. I mean, you can see all the diversifiers trying to act as quickly as possible because no one wants to become the dinosaur industry. But at the same time, Rio Tinto, a couple of weeks back, came out with their huge investor seminar, 180 slide deck, announced they're going to be 7.5 billion on effectively green capex. And the market, was horrified, which is, it's ridiculous. So they're damned if they do, damned if they don't. I mean, for me, the most important thing diversifiers can do is investing in future enabling commodities like copper, nickel, etc., and maintain the supply discipline where they should on the more polluting items, whether it's lower grade iron or coal, etc. But yeah, it's a tricky one. It's not easy for them.
Okay. Who else wants to comment on that? Rob, do you think they're going quick enough?
I mean, I think they're generally doing a good job, but it's just difficult. There's no kind of set standard. There's no set policy, tick box rules process. I mean, the reality is, would it make a big difference today? I'm not so sure it would. But I think going forward, increasingly it's becoming, clearly becoming a focus. I think having a set standard, clearly would be beneficial. But at the moment, they're sort of transitioning that way, and it's that pull factor where I think a lot of shareholders are still more focused on returns. If you're kind of like an oil company, running down your 25% IRR project to invest in a 3-4% IRR project, what multiple do you apply to that? and then there's a free cash flow aspect. But moving forward, clearly that is the way it's going. Will it make a huge difference today? I don't know, but I think it's important that our industry addresses it.
I'll restrain my own commercial interests here in answering your point. But Ian, would you like to comment?
Yeah, there's another point. If you're looking at the switch from petrol cars to electric cars, it's worth having a look at what's going on in China with the manufacture of electric cars. So there's about 300 car firms in China. And if you take a little electric car like a Mercedes smart car electric version, in the UK it costs £23,000, has a range of about 68 miles or something on a plug-in, and you're great for driving down the shops. There's a car in China that is an exact copy of it. I mean, if you put the two together, you wouldn't be able to tell which one was which. The Mercedes costs 23 grand, the Chinese one costs 4 grand. Okay. And it has a greater range because Chinese battery technology is probably better. So if you're looking at the switch to electric cars, you're also looking at potential decimation of the EU car industry, because there's no way they can compete with the cars coming out of China. You can buy, this is a real car, it's not a concept car. You can go on Alibaba and you can buy a brand new car, brand new electric car today for £900, brand new. So that's probably more than the Mercedes steering wheel cost. So it's obvious who's going to dominate the market in electric cars. They've been planning it for 10, 15 years. That's why they've been going around the world trying to source up all the supply of copper they can get their hands on. They're just going to dominate. So the manufacture of these electric cars is going to switch to Asia in a massive way. It's not coming back. So while the EU can be as green energy minded as they like, the Chinese are only interested in dominating the car market, and ESG credentials out there will take a big backseat to them taking 80% of the car market, like they got 80% of every other form of manufacturing.
Thank you. Graham, just on a slight angle on it, and just in 20 seconds, because we want to get on to some questions. Are the indexes, are the exchanges going to ramp up their ESG requirements as part of that, and particularly with regards to your own one, or is this kind of slightly the tail following the dog, so to speak?
I think they probably have to. Obviously, I can't speak for other stock exchanges, but within the TSX and the TSX Venture Exchange, we've now got a small but dedicated team looking at matters ESG. We publish guidance for our companies. We run classes and tuition modules for executives of companies on best practice and developments in the thinking about it. So I think the exchanges have to do it. As I said, the danger is that otherwise industries like mining and like hydrocarbons will disappear from public markets, and I think that would be a disaster in lots of ways.
Thank you all very much indeed. Let's open to the floor for any questions. I've got one for one particular fund manager, if there are none. So can I see any hands right at the back? I'm not sure there's a mic. Oh, there is, right behind you, Adam. Adam, behind you.
I don't really need a microphone, as you all well know. There's an awful lot of sort of manifest destiny, and this is bound to happen. And it's going to be 1 trillion tons of that and a quadrillion of this. We all know that can't happen because it isn't there. It's not there even at any price. So obviously they're going to be intervening technology solutions. But the idea, and this is an observation, not a question, but the panel's welcome to throw the ball back at me hard. It's highly implausible that the car industry is quite important, even to this country in our post-industrial glory. The idea we're just going to close down the car industry, because you say the electric car industry, that is the car industry. Close it down and let China produce the power that it's going to produce from newly built coal power stations, without doing anything about it, any more than we're going to have 1 trillion tons of this and a quadrillion of that. Technology innovation will intervene on the former, and politics will intervene in the form of aggressive tariffs and sanctions on the latter, in my opinion, if we can follow this to its truly logical conclusion rather than its fancy island ones for the resources industry.
Well, I mean, obviously the EU, whose motor industry is most at risk, its initial jerk reaction to this is going to be protectionism and to try and protect their industry. But the EU is 400 million people out of a global population of 7.6 billion. So they can put in all the tariffs and all the nonsense and safety measures that won't allow them in. But they won't be able to stop Brazil buying these cars, or the rest of Africa buying the cars, or Indonesia buying these cars. We're talking global car market. And the price difference is so enormous that an Indonesian wants to buy an electric car. He's not going to pay 23 grand for a German car if he can buy an identical one from China for 4 grand. It just isn't going to happen. So they're going to. The EU can do what it's like. It thinks protectionism makes them wealthy. Well, dream on, because it's not going to. This isn't going to go away. China is going to dominate the car. They've been planning it for 20 years. But by 2030, when I went to Shanghai, I can believe how many of all the taxis were Volkswagens, diesel Volkswagens, all running around Shanghai. In 2030, they're all banned from the road. In Shenzhen, all the buses are electric, made by Chinese companies. All the taxis are electric. That's the model that they're going to roll out for the whole of China. And once they've done that, they're just going to export these cars all over the world.
Sooner the better, because the pollution is still pretty bad. Is there one final question before we get superstar Paul Cronin with Adriatic coming up onto the stage to give his presentation? Is there one other question from the panel, from the floor? Paul. I hope you're asking them. You are.
Well, I'm dying to buy one of these little Chinese cars. It's General Motors have a marketing and thing, so this is going to end up in America as well. I'm dying to buy one of these things for 4 grand. There's no way I'm going to spend 23 grand on a car when I can buy an identical one for 4. And plus, the reason is. No, I've got 2 cars. One's a sort of semi-Ferrari, and one is but the reason I want to buy this one as well, not as a replacement, but if I go down to the commuting, annual season ticket on the commute is £650 to park the car. Electric cars only £80 a year. No congestion charge, no ULIP charge, no fuel charge, no repair bills.
Not yet.
And I just want it to make 3-4 mile journeys. I don't want it to replace. If I drive down to Devon, I'm not going to go in this thing. It stays in the drive.
I'm going to hold it off there because am I allowed to ask one more question, organisers? Go on, a quick one, and then Paul can come up for his.
The governments, politicians want the world to drive 30% of electric vehicles by 2030. So it's got 9 years to go. When you talk to the mining companies, they say, well, there's no way we can get that value because it's time 20 times X nickel, 20 times X copper, and you just said that. So what is going to happen? Is obviously your 5-year bull market is a really nice story, but is it going to happen? What do you think can happen? Because 30% is not realistic at all.
Well, look what's happened with the car industry and microchips. We can't get the microchips, can't make the cars. If BMW and Mercedes can't get the copper, they can't make the cars. So it depends not just on the price of copper, but who has tapped up the long-term supply of copper, which again takes you back to China, which is what they've been doing for the last 20 years, going around any copper mine that's on the market, they've been trying to buy or have bought.
So, Ian, you're definitely a price driver. Rob?
Yeah, I mean, look,
Ben, I'll come to you for the final words, unless, Graham, you've got a particular view on this.
yeah, it's all price. You just need to get to sufficient demand destruction. But clearly these targets aren't going to be hit. We can all see that there isn't. There just isn't the supply. Politicians don't get that. But price has to go higher to create the demand destruction to balance it.
Ben?
Yeah, and one we always struggle to forecast is thrifting ability, technological advances, and recycling. They're all murky parts which could have huge breakthroughs, or it just comes back to demand destruction.
Yeah, I mean, for example, there's quite a lot of copper that hasn't been recycled for environmental reasons because they couldn't clean it up. But in the grand scheme of things, that's still relatively small.
Panel, thank you very much indeed. Floor, thank you for your questions. And thank you to the organisers for today's event. Thank you all very much indeed. Have a good conference.